Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is the December 8th edition of Market Outlook. Don't forget to sign up for this to get it free every week. So, great economic news, and bonds hardly budged. So, those are the predominant headlines, as well as Bitcoin running away and getting up to almost 1200, capturing the imagination of many people around the globe, including Chinese regulators, Bank of America, and buyers of high-end cars. So let's take a look at where the markets are, where they're likely to find support and find levels of resistance. First of all, let's take a look at the spider chart, and as you can see, you have a interesting channel line at the top, which would indicate if the market continues and takes out the recent highs in the spiders, upward momentum should find some resistance at the 187 level, approximately. Now, interesting to note, number one, we are not overbought on a short-term RSI or price level. Friday had a really pretty good size day of accumulation. Now, prior to that, we've actually had several distribution days, but this accumulation day, again, moving through the 10-day moving average, of course, we're in a bullish phase. Now, overall, support should be found around the sharply rising 50-day moving average and that 175 level, which was where the major sell-off stopped dead in its tracks. You sort of got the big reversal candle, and again up to new highs, another pause, and then with the spate of great economic news, the market rallied sharply on Friday. And again, what's interesting here is that on a daily basis, not overbought. Picture looks a little bit different on the monthly and the weekly. Let's take a look. The weekly and the monthly charts here. Let's take a look at the weekly S&P chart. Aha. Okay, so you can see on the weekly chart here, the short-term RSI is and has been overbought for a period. We're also, in terms of a weekly channel, actually hugging the upper end of the weekly channel with it being overbought on the weekly. So that is definite cause for a little bit of concern. We really need to power out of this to get that upside acceleration, which would, going back again to the daily chart, show some pretty good resistance up around that 187 level. Now, Qs, let's take a look and step back at the Qs. As you can see, what we have here is a monthly chart. And for much of 2012 and even an early part of 2013, we were lagging, but with Apple really roaring in the second, third quarter of this year, really helped put some acceleration into the NASDAQ 100. Now, importantly, you have a pretty well-defined trading channel going all the way back to 2000. So that is very much intact and should offer really important support. But of course, that's much lower. That's around the 72 to 73 level. But on a long-term chart here, you can see that the uptrend that started in 2009, nicely intact, major support around the 70 level, and also the longer term moving averages in the monthlies are this 23 month moving average, along with this trend line, should offer some really good support up around the 74, 75 level. And that would also fall a little bit above what I would consider this compression range here around the 70 level. So Really pretty good support in this market overall underneath. And right now, you can see the NASDAQ on the monthly is in overbought territory. That doesn't mean that these monthlies can't get overbought, but again, are we running rich on a price level on a longer term basis? Absolutely. If we get to the shorter term charts, the daily charts, let's take a look. You can see on a daily basis, we broke out again to new highs on Friday, but we are not really overbought on a shorter term basis. So more room to the upside, a little bit of a cautionary note in the bigger picture. So what you want to be doing is being a little bit more aggressive about taking profits on strength. Let's go to some of the market internals. The S&P, the McClellan oscillator, which looks out over the next several weeks to a month or more, looking at advanced declines and up-down volume, right dead smack in neutral range. So there's plenty of room to move to the upside and or to the downside. So we're not getting much of a reading from this indicator. In terms of the shorter term, advanced declines and up-down volume on a 10-day basis, right in the middle pretty much of the trading bands, and can't really infer anything from there. So not much help on market internals. Let's take a look at sentiment. Sentiment, you can see we are now trading back into the Bollinger Band with the 4 or 5 day sell-off that we had prior this earlier in the week. We actually moved above the upper end of the Bollinger Band, causing a little bit of concern, but with Friday's fantastic action, move back down. So it's neither overbought nor oversold, and just trading in the middle of the band, which is still in overall positive mode. You can see the 50 and the 200 day, we're trading under it and inside the Bollinger Band. So it's neither extreme on either side. Volatility is about normal. Now let's take a look at bonds as well. Bonds, TLTs, this chart tells the story. You can see I drew in a critical support level right around that 102 level. Now, what's interesting on Friday, with the great economic news, people are thinking that the rise in rates is already priced in, as the market barely, the bonds, the 20-year bonds, barely responded. And if anything, they were actually rates actually dropped a little bit on Friday. So that is pretty good news for the overall market. That this it's indicating that whatever the earlier drop this year in rates, drop in prices and rise in rates has been absorbed, and the market might be able to even take the tapering in stride. Again, the forget about the rhetoric. Look at the pricing. If we drop beneath this 102 level, that is a really critical level. You're talking about a 6 or a 7 point drop in terms of the count from what this would look like. So that would bring it down to the 95 level. But more importantly, if you look at the monthly chart, the 80 monthly average, which has been holding here, that 102 level, would be penetrated. That would really signal the end of the long-term up move in rates, in prices of rates, and the the end of an era of lower interest rates. So meanwhile, we're holding on. We're on the cusp. It's a critical level. If we do penetrate that, it might create some trouble for the markets. On the other hand, if we can power out and actually stabilize here or move a bit higher, it would mean that interest rates can absorb and they're going to remain steady. So in effect, the tapering really affected the would affect the long end of the yield curve and not the short end. And if that is the case, the market could easily absorb this good economic news and not get too hit by the rates, and that would actually lend lots of support to the market, in the stock market in general. But it still remains to be seen. The jury's still out. Markets could change their opinion here as economic conditions improve and or accelerate. So we have an improving economy, tepid response by the bond market, and a great response by stocks, sort of the perfect overall environment. If we take a look at gold, let's take a look at gold here. And you can see as well, gold, not really the asset class of choice, while the stock market is getting great economic news. Obviously, the concept of gold as a alternative currency or safe haven when equities get crushed is now quite a bit abated. So again, gold just scraping along the lows. We did have somewhat of a reversal pattern back here in late June and early July. We're testing those levels again. We really need to hold here. If we can't hold the lows from late June, early July, you're looking at a potential sell-off to maybe $1,000 an ounce in gold, which would equate to about 100 or so in GLD. Okay, that's it for now. Hope you enjoyed this. And again, don't forget to sign up for this newsletter by going to the website, marketgauge.com, and you'll find a box to put in your email address and get this for free every week. Thanks, and bye for now.